The main goal of hands-off investors is to make money while they sleep. You might be able to do that if you find the best sources of passive income. Chances and requirements change depending on the type of passive income. Still, they usually ask for an initial investment that will bring in income for a long time without the investor having to keep track or of changing their holdings. Let's talk about 5 passive income ideas that you can opt for. Dividend investing. Dividend investing is one of the easiest and most convenient ways for investors to make passive income. This means buying shares of companies that pay dividends to get a steady stream of income from their investments. Shareholders of a corporation, which is usually a public company, can get payments from the corporation in the form of dividends. When an investor buys stocks that pay dividends, he or she gets a piece of the money the company makes. Many investors expect to get payments from the company on a regular basis as a reward for keeping their money in the company. This gives them the chance to get a steady stream of income on top of any increase in the value of their portfolio due to the company's stocks or other holdings, share price appreciation. Not every company, though, has a dividend policy. Most of the time, a company's board of directors decides whether or not a dividend is good for the company, taking into account a number of financial and economic factors. Stockholders usually get their dividends as cash payments once a month, 3 times a year, or once a year. Dividend rates can vary a lot between companies, and they can also change from one year to the next. So investors who don't know which dividend-paying companies to choose should stick to companies with the title Dividend Aristocrat. This means that the company has a history of paying high dividends for at least 25 years. How do you choose the best dividend-paying stocks? When looking for dividend-paying stocks, it's important to think about the following things. Long-term profitability is a very important thing to think about. Look for businesses that say they will make more money and make more money over the long term by between 5 and 15%. Make it a priority to look for businesses that bring in cash in a healthy and long-term way, since this is a requirement for paying dividends. A track record of at least 5 years of good dividend payments, which shows that dividend growth will continue. Stay away from companies that pay dividends but are struggling because they have too much debt. Check a company's debt-to-equity ratio and don't invest in companies with ratios higher than 2%. In addition to looking at the basics of a certain company, you should also learn about the trends that are happening in the industry as a whole. Crypto staking. Staking a cryptocurrency is a way for people who own digital assets to put them to work without having to sell or trade them. Based on information from Staking Rewards, the total value of all cryptocurrencies that have been staked has grown over $280 billion as of April 2022. Staking cryptocurrency is very similar to putting money into a high-interest savings account. When you put money into a savings account, the bank usually takes those funds and lends them to other customers who also have savings accounts. In exchange, you will get a share of the interest that builds up because of the loan. In a similar way, staking your digital assets means locking up the corresponding currencies to help the blockchain network run and keep its security up to date. In exchange, you may get incentives that are given as a percentage yield and are, in most cases, much higher than the interest rates offered by banks. Proof of stake, or POS, is the only way to reach a consensus that lets people stake. This is how blockchains choose honest users and make sure that new blocks of data are correct before they are added to the network. Participants in the network, who are also called validators and stakers, buy and store a certain number of tokens as an incentive for good behavior in the network. If unethical behavior caused the blockchain to be hacked, the price of the native token that is connected to it would almost certainly drop sharply, and the person or people who did it would be at risk of losing money. Because of this, staking is a good way to stop fraud and mistakes in this process. Peer-to-peer, or P2P, lending. Peer-to-peer lending, which is also called social lending or crowd lending, is a way for people to get loans directly from other people. This means that a bank doesn't have to act as a middleman between the borrower and the lender. At the moment, most peer-to-peer lending platforms are in the United Kingdom and the United States. However, the trend is slowly spreading to Europe and a few Asian countries. Peer-to-peer lending is a way to connect people who have extra money and want to lend it to people who need credit. This means that lenders can get a better return on their investments and that borrowers can get quick loans in a more convenient and clear way online. Lenders get the money they loan back every month in the form of EMIs, which are equal monthly investments that include both the principal and any interest income. The platform for peer-to-peer lending collects the monthly interest payments from the borrower on behalf of the lender. The money is then put into an escrow account for the lender, from which the lender can either take the money out or reinvest it. Another important part is that the lender's risks are spread out. This means that tens or hundreds of lenders with different risk profiles, demographics, and jobs work together on a single loan. This is an important thing to think about. If the borrower goes bankrupt, the investors will take less of a financial hit because the loss is split among more people. Peer-to-peer lending platforms also use cutting-edge products and methods to speed up the process of building a portfolio, which saves both time and work. Putting money into index funds. An index fund is a type of mutual fund or exchange-traded fund with a portfolio that tries to match the parts of a financial market index, like the S&P 500. Passive income vehicles are another name for index funds. If you invest in index funds instead of picking individual stocks, you can own a piece of a number of different companies. Index funds are also cheap, let you diversify more, are usually low risk, and give you high returns over the long term. Index funds are usually thought to be the best core holdings for retirement accounts like individual retirement accounts, IRAs, and 401k plans. The Standard & Poor's 500 Index is one of the most well-known ones. This is because the 500 companies it looks at are large, well-known businesses based in the United States, and they come from a wide range of industries. Real Estate Investment Trusts, or REITs. Real estate investment trusts are companies that own, manage, or finance real estate properties that bring in money, such as apartments, storage facilities, warehouses, offices, shopping malls, and hotels. They are a popular way to invest for people who want to diversify their portfolios beyond publicly traded stocks and mutual funds. REITs allow individual investors to get dividends from real estate investments without having to own, manage, or finance any properties themselves. Most REITs are also traded openly on major stock exchanges, which is similar to how stocks are traded. This makes them very liquid products, unlike physical real estate investments. When it comes to how their shares are bought and held, REITs can be put into the following categories. Private REITs are not registered with the SEC and don't trade on national securities exchanges. Publicly traded REITs are listed on a national securities exchange, which is where individual investors can buy and sell them. Public non-traded REITs are also registered with the SEC, but they do not trade on national securities exchanges. The National Association of Real Estate Investment Trusts says that about 145 million people in the United States own real estate investment trusts, either directly or indirectly through their retirement savings and other investment funds. Start by opening a brokerage account so that buying and selling real estate investment trusts is as easy as buying and selling any other stock. If you don't want to trade individual REIT stocks, it may make a lot more sense for you to buy an exchange-traded fund, or ETF, or a mutual fund that evaluates and invests in a wide range of REITs. You get quick diversification and a lower risk, and investing in them takes less time than looking into individual REITs in order to invest. Thanks for watching this video. Please make sure to hit like and subscribe to this channel for more.